When you order a pizza and claim a slice for yourself, you are taking ownership of one part of a larger whole. Buying a stock works exactly the same way, just on a corporate scale. A stock represents literal ownership in a real-world business. When you buy a share, you legally become a part owner of that company. Consider an entrepreneur named Alex. She wants to open a neighborhood pizza shop, but she needs $200,000 to buy ovens, lease a building, and hire staff. She only has $100,000 saved, and she wants to avoid taking out a bank loan that would require her to pay back heavy interest. Growing a business costs serious money. Founders need a mechanism to raise capital, the money needed for business operations, without taking on the burden of debt. To raise that money, Alex divides her entire business concept into 20 equal pieces. Since the total business needs $200,000 to launch, each share is valued at $10,000. Alex keeps 10 of those shares for herself, securing her 50% ownership. She then offers the remaining 10 shares to outside investors to raise the missing $100,000 directly for her startup costs. A local customer named Sam likes her business plan and buys 2 of those shares for $20,000. By making that purchase, Sam now owns exactly 10% of the pizza shop. Selling shares is a mutual exchange. The founder gets debt-free cash to build their dream, and investors get to own a percentage of the company's potential success. 3 years later, the pizza shop is a massive success. Alex has opened new locations and built a loyal customer base, and as a result, the entire business is now valued at $500,000. Because Sam owns 10% of a $500,000 company, his original $20,000 stake has jumped to $50,000. If he sells his shares today, he walks away with a $30,000 profit. However, risk is a factor. If a major competitor opens and the shop struggles, the total valuation of the business might drop to $150,000. Sam's 10% stake would shrink to $15,000, a $5,000 loss. This constant fluctuation in the underlying value of a company drives the daily supply and demand of the stock market. If more people want to buy Sam's shares than sell them, the price goes up. If everyone tries to sell and nobody is buying, the price drops. Stock prices serve as a real-time consensus of a company's current value and its future potential. Some established companies offer a bonus perk to their investors, called a dividend. A dividend is a portion of the company's profits distributed directly back to shareholders. It functions like a regular rent check, rewarding you for owning the stock. To see this on a larger scale, imagine Alex's pizza shop becomes a massive national chain, opening hundreds of new locations from coast to coast. To fund that expansion, a company may go public through an initial public offering, or IPO. An IPO is the very first time a company lists its shares on a public stock exchange, like the NYSE. The NYSE stands for the New York Stock Exchange. Once that happens, anyone can buy a fraction of the business through a phone app. Going public transitions a company from a closed club of original private investors to an open, global marketplace. When you buy into one of these public companies, you have a choice in the type of ownership you want. Not all shares offer the same rights to the buyer. Common stock is the standard choice. It typically grants you 1 vote per share on major company decisions and offers the highest growth potential if the company succeeds. However, common stockholders are the last to get paid if the company goes bankrupt, which carries higher risk. Preferred stock is a more conservative alternative. You sacrifice your voting rights in exchange for prioritized, fixed dividend payments. If a company fails, preferred stockholders are paid out before common stockholders, offering more stability but less explosive growth. Choosing between these options depends on your strategy. You can prioritize aggressive, long-term growth or opt for reliable, steady income. With these risks in mind, you may wonder why investors subject their money to the market instead of keeping it in a safe bank account. This line graph compares those two strategies over a 50-year timeline. A standard savings account might yield 0.5 to 4% interest annually. Historically, the broader market has returned an average of 10% per year. We measure that market using the S&P 500, which is an index tracking the 500 largest public companies in the United States. If you look closely at the market line, you'll see severe short-term dips. You might be up 25% one year and down 15% the next. Because of this volatility, financial experts recommend an investment horizon of 5 to 10 years to recover from these temporary losses. This patient approach focuses on buying quality companies and holding them for years. It is distinctly different from day trading, where people try to profit from minute-by-minute price swings, a high-risk strategy where most participants lose money. Money left in a bank slowly loses purchasing power to inflation. Generating long-term wealth requires trading the safety of a savings account for the calculated volatility of the open market. Before you buy your first share, you need to establish a safety net called diversification. Spreading your capital across different industries, owning slices of a pizza chain, a tech giant, and a clothing brand simultaneously, ensures that one company's failure doesn't wipe out your entire portfolio. Owning stocks provides foundational ownership in the businesses that build and sustain the broader economy.